yesterday. It was scary. After a very large rally, emotions tend to get too high. And then when they get too high and there's a sell-off, they go very, very low, very, very quickly, and you lose your emotional balance. And some people can get thrown off, especially if they decide to take leveraged trades. One last reminder, gold and silver are going to have periodic sell-offs until the Fed engages in its final printing round. That is coming, and only at that time will gold and silver just go up day after day after day until the dollar is dead.
In today's news recap, gold extends losses near $4,100 as traders brace for renewed volatility. Gold continued to retreat on Wednesday, extending losses after its sharpest single-day sell-off in more than a decade. The metal traded around $4,100 an ounce, slipping further after Tuesday's 6% collapse, while silver steadied near $48.55, unchanged from its opening level. The correction has paused a 2-month rally that pushed gold and silver to historic peaks, driven by fears of currency debasement and expectations of major Federal Reserve rate cuts, with volatility surging and investors' repos. There's been only 2 market commentators so far highlighting that this could happen, Celente and Lobo Tigre, while the rest of so-called analysts, brokers, and dealers were hyping it up for higher prices. The truth is, gold's meteoric rise has cooled sharply, with the metal now consolidating near $4,100 following a dramatic sell-off that erased more than $250 in value since Monday. Tuesday's 6.3% plunge, the steepest intraday drop in over 12 years, marked the end of a rapid advance fueled by safe haven flows, central bank accumulation, and the so-called debasement trade. While spot prices have steadied slightly from Tuesday's lows, volatility remains elevated. 1-month implied volatility for gold options hovers near the highest level since early 2022, signaling that traders are bracing for further turbulence. Many funds are now re-hedging positions after the sell-off, using options to guard against a break below the key $4,000 support. The surge in derivatives activity follows months of record ETF inflows and aggressive physical demand from central banks dynamics that amplified both the rally and the correction. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Strange thing that I saw from yesterday and 2 days ago, and actually this whole past week, is the borrow fee for SLV specifically. This does not apply to PSLV. It doesn't apply to the other gold or silver ETFs. This is just a SLV specific thing. SLV is the silver ETF with the biggest liquidity, with the largest liquidity. You see here that the borrow fee for SLV went above 19%, almost to 20%, which means there was a lot of demand to short this ETF. Some people apparently knew that there was going to be some kind of sell-off, whether they are silver market insiders or hedgers or banks playing unfair games. I don't know who they were, but this doesn't always portend a sell-off. But we saw here in February, in early February, the borrow fee went up to about 16%. That didn't really lead to much sell-off in February 2025, though this one apparently did. So sometimes they can be wrong, sometimes they could be right. But this big borrow fee spike in SLV did predict that something might happen, and apparently it did. Not at all. So they're still holding on to their short positions, and why is that? We'll go into in a minute. 473,401. This is from the Comex website. These are more up to date. They do not have a 24-hour lag. So you can see here the number says 2,537 contracts closed. However, it's not that much. This is a misleading number because the actual number is 1,006. How did I get to 1,006? I'll tell you why. Because there was 1,531 gold warrant deliveries yesterday in October gold. So That means that open interest closed out 1,531 because every time there's a delivery, a contract closes. Every time something happens, an angel gets its wings, or whatever the saying is. So if 1,531 contracts closed, but they didn't really close, they got delivered. So how many shorts actually bought back their contracts rather than delivering? You have 2537 minus 1531, and that's 1006. On a day when gold is down 6-7% or whatever it was, you only have 1006 contracts closed. Plus, you have huge buying in the October 25 contract. You have a rise of 759 contracts here with 1531 deliveries. So net buys would be 1531 plus 759. And that is like 2,300 contracts, something close to that. A net buying of 2,300 over that contracts in spot gold when gold is down 6-7%. Also, you have 395 contracts bought net in November, which it goes to delivery in, I think, 4 or 5 business days. So somebody was buying either spot gold or very close to spot gold yesterday. Yes, the futures, the December 2025 active futures fell about 4,000 contracts, which is not a big number to fall, but it did fall. But we can see here a more detailed depiction of what happened yesterday. So we have 3 things. I wrote here: high, not high, and very high. What is not high? That is the current open interest of 476,000. We saw this on the previous slide, but this is a more zoom out so you can see back to 2020. We have here a price high and then a sell-off over here. This should have led to a huge sell-off in open interest, but it did not. Open interest barely moved, just over 1,000 contracts, but we did have very high trading volume. So what does it tell you that we had high trading volume, but contracts did not close out? So we did have a lot of sellers. That's where the volume comes from. But we also had a lot of buyers who were not the short sellers, because if the short sellers buy back their positions, those contracts get canceled out and they get erased from open interest. That's not what we saw. We saw people other than the short sellers buying the contracts that the longs were selling in this sell-off. Now, why is it that the short sellers did not buy back their contracts on this 6-7% plunge in gold?
In today's news headlines, London bullion chief seeks gold futures revival. The new chair of the London Bullion Market Association has urged the revival of gold futures trading in the UK, despite earlier failed attempts to establish derivatives contracts in the world's largest physical gold trading center. Peter Zoellner, whose organization represents bullion trading banks, told the Financial Times on Wednesday that previous efforts to launch gold futures in London had been premature, but added the global market would benefit from having 2 or 3 places with decent liquidity. I think it makes sense that the gold market can trade on different venues, Zoellner told the newspaper. Sometimes people start something a bit too early. Maybe we are in a different situation. His comments come as uncertainty surrounding President Trump's tariff policies has raised concerns about trading on U.S. exchanges. London Metal Exchange volumes for base metals have risen this year, whilst New York's have declined, said the Financial Times. London's bullion trade predominantly occurs through bilateral over-the-counter physical transactions with no futures market. CME Group's Comex operates the most liquid gold futures contract in New York, followed by Shanghai Gold Exchange. The LBMA is also considering releasing more pricing data publicly, including forward contracts and real-time prices. Zoellner, formerly head of banking at the Bank for International Settlements, said developing a strong benchmark for a forward price would enhance market transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Something else that is going on in gold, and that is a lot of deliveries keep happening, and they are every day. That's sustained over 1,000 deliveries a day, over 1,500 even. Some days 2,000, some days as high as 4,000. Yesterday was 2,442 deliveries. We were up to 57,517 deliveries for October 2025, and that is so far the third highest month ever, and it looks on track to become the second highest month ever. There's a chance that it could become the highest delivery month ever. We'll see that on this next chart over here. This is where we are. 5.75 million tons of gold warrant worth delivered. That has exceeded the May 2020 high of about 55,000. We're now at 57,000 contracts. This is the all-time high over here a few months ago. In early 2025, I think it was 7.6 million ounces or 76,000 contracts. So I think we're going to break this over here. I'm not sure what month that is. It was this year. But looks like we're going to break it. And October isn't even a front month. It's not even an active delivery month. But the next active delivery month is December. November is not active either. But for October, this is definitely a record for October. And it's almost an all-time record. Third highest delivery month. There's huge deliveries going on in Comex right now.
I.C.Wiener.
Delivery for, icy wiener. Oh, crud.
What about GLD? Here's another indication that there was a lot of dip buying also in ETF investors, because normally when GLD falls, and it fell, I think it was the fourth worst day for GLD. It was either the third or the fourth worst day for the GLD price, GLD Gold ETF, the Spider shares. Fourth worst day ever. And on a day like that, you would expect that the ETF would lose gold tonnage or gold ounces, because that's what happens in order to keep the GLD price in line with the gold price, the gold futures price. If the price goes down, there's a big sell-off. Usually they have to take ounces out of the fund in order to keep the share float aligned with the price. This time, there was no change in GLD holdings at all. 0 million ounces or just 0 ounces were moved from the fund yesterday despite the humongous sell-off. So what does that tell me? It tells me that there was demand for the ETF yesterday as dip buyers came in and took positions, saving GLD from having to shed gold ounces in order to keep it in line with the gold price. Because once it sheds gold ounces, there are fewer GLD shares available. The shares supply gets constricted and it stays in line with the gold futures price. That's the idea how these ETFs work. So what I'm saying is there was dip buying in gold futures. There was major dip buying in GLD ETF. So I think, I'm not saying that this sell-off is done necessarily, but there were a lot of buyers that came to take advantage of this sell-off and to get into gold investment vehicles and gold futures at a much lower price. The last chart that I'm going to show is it's not just New York that is stockpiling gold, that has a near record amount of gold supply. It's also China. You can see here since 2024, the amount of physical gold in China, and you can either trust this chart or not trust it. I'm just showing it to you. I don't know what to really make of numbers and statistics in China. They could all be lies for all I know, but for what it's worth, it says here that in 2025, the gold supply, physical gold warrant supply in China, in Shanghai, I think this is at an all-time high, 84.606 tons, which is 2.7 million ounces. That's still about 10%, maybe a little bit more, like 12% of what's in New York. So this is still a pretty small stockpile of gold, but it is going up.
What do you think of Rafi's take? Do you agree with him? Is this gold and silver correction just a healthy opportunity to buy more, or is the bull run at risk? Post in the comments section your honest opinion and share with the stackers your plan. Now smash the subscribe button and check this video right here because you'll love it, and I'll see you on the other side.